Warren Buffett calls it the best book on investing ever written. Benjamin Graham's The Intelligent Investor has been the foundation of every serious financial thinker for over 70 years. But here's what nobody tells you. This book is not just about picking stocks. It's a framework for making better financial decisions under uncertainty. And when you combine Graham's principles with AI, you get something dangerously powerful. A system for seeing clearly when everyone else is guessing. This is the AI CFO breakdown of The Intelligent Investor. First, who was Benjamin Graham? Born in 1894. Grew up poor after his father died when he was 9. Graduated Columbia University at 20. By his mid-30s, he was one of Wall Street's sharpest minds. He survived the 1929 crash. Lost almost everything. And instead of quitting, he studied what went wrong. That pain became the book. The Intelligent Investor, first published in 1949, is built on one core belief: the market is not rational, but your response to it can be. Graham didn't just teach investing. He taught discipline. And discipline is exactly what separates a reactive finance team from a strategic one. Principle 1. Margin of safety. This is the single most important idea in the book. Graham says, never pay full price for anything. Always leave a buffer between what something is worth and what you pay for it. If a stock is worth 100, don't buy it at 95. Buy it at 70. That gap is your margin of safety. It protects you when your assumptions are wrong. And they will be wrong. Now here's the AI CFO angle. Every financial forecast you build is a guess. Revenue projections, expense budgets, runway calculations. They're all estimates. Graham's lesson is, build the buffer in. When you use AI to model your cash flow, don't just run the base case. Run the worst case. Cut your revenue projection by 20%. Add 15% to expenses. If the business still survives, you have margin of safety. That is how a real CFO thinks. Principle 2. Mr. Market. Graham invented a character called Mr. Market. Every day, Mr. Market shows up at your door and offers to buy your shares or sell you his. Some days he's euphoric and offers crazy high prices. Other days he's depressed and wants to sell for almost nothing. The key insight? You don't have to accept his offer. Ever. Mr. Market is there to serve you, not to guide you. For a CFO, Mr. Market is everywhere. It's the vendor who pushes you to sign a 3-year contract today. It's the investor who says raise now before the market turns. It's the panic when a competitor announces funding. AI helps you cut through the noise. When you use AI to analyze your actual data, you stop reacting to Mr. Market and start responding to reality. Emotion goes down. Clarity goes up. Principle 3. Investing versus speculating. Graham draws a hard line. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Everything else is speculation. Read that again. Thorough analysis. Safety of principal. Adequate return. Most business spending fails this test. That marketing campaign with no tracking. Speculation. That new hire with no clear ROI model. Speculation. That SaaS tool nobody evaluated. Speculation. The AI CFO approach is, run the analysis before you spend. Upload your data to Claude or ChatGPT. Ask it to calculate the expected return. Ask it to identify the risks. Ask it to compare alternatives. Turn every spend decision into an investment decision. That's what Graham would do if he had AI. Principle 4. The defensive investor. Graham describes 2 types of investors. The enterprising investor who actively seeks opportunities. And the defensive investor who focuses on protection. Most people think they're enterprising. Graham says most people should be defensive. Because the defensive investor wins by not losing. For a CFO, this is the most underrated strategy in finance. Don't chase growth at all costs. Protect the downside first. Build your cash reserves. Lock in your fixed costs. Reduce your exposure to single points of failure. Then, and only then, play offense. Use AI to run a defensive audit on your business. What happens if your biggest client leaves? What if revenue drops 30% for 2 quarters? What if you can't raise your next round? If you don't have answers to these questions, you're not being defensive. You're being reckless. Principle 5. The importance of analysis over emotion. Graham was obsessed with data. He built spreadsheets by hand decades before Excel existed. He believed that rigorous analysis was the only defense against bad decisions. Not intuition. Not experience. Not confidence. Analysis. This is where AI changes everything. Graham spent weeks analyzing a single company. Today, you can upload 3 years of financial data to an AI and get a complete analysis in minutes. Variance reports. Trend detection. Anomaly flags. Risk scoring. The tools Graham wished he had, you have right now. For free. The question is, are you using them? Most finance teams still make decisions based on gut feel and last month's numbers in a spreadsheet. Graham would call that negligence. An AI CFO calls it an opportunity to be better. Principle 6. Price is what you pay, value is what you get. Graham hammered this distinction relentlessly. The market price of something tells you nothing about its true value. A stock trading at $50 might be worth $20. Or $200. Price alone doesn't tell you. Only analysis reveals value. For a CFO, this applies to every line on your P&L. You're paying $12,000 a month for that marketing agency. But what's the value? You're paying $200 per seat for that enterprise software. But what does it actually produce? Use AI to calculate the real cost per outcome of every major expense. Not just what it costs. What it returns. When you see value clearly, you stop overpaying for things that don't matter, and you start investing more in things that do. That's Graham's edge. And now it's yours. Let me put it all together. The AI CFO Framework, powered by Graham. Step 1. Build margin of safety into every forecast. Never trust the base case alone. Step 2. Ignore Mr. Market. Make decisions from your own data, not from external noise. Step 3. Turn spending into investing. Analyze before you allocate. Step 4. Be defensive first. Protect the downside before chasing upside. Step 5. Replace emotion with analysis. Use AI to see what you're missing. Step 6. Know the difference between price and value. Measure what things produce, not just what they cost. 6 principles. Written 75 years ago. Still the most powerful operating system for financial thinking. The only thing that's changed is the tools. And the tools just got a lot better. Benjamin Graham gave us the playbook. AI gives us the speed. Together, they make you the most dangerous kind of financial operator, the one who sees clearly, moves fast, and never overpays. Subscribe to AI CFO. Every week we break down the frameworks and tools that turn you from a number cruncher into a strategic weapon. If you want the AI CFO prompt pack that applies Graham's 6 principles to your own